Head of forex at Investec in Johannesburg on the telephone, David Gracey. David, I don't know if you're old enough to remember a group called Frankie Goes to Hollywood. They came up with a line in one of their songs, "War, what is it good for? Absolutely nothing." Currency wars, what fun.
Yeah, absolutely. So we saw the latest salvo from China over the last 2 days, and that's obviously fed through into emerging market weakness.
Yeah, is this to do with the SDR, the Special Drawing Rights Club, which China wants to be part of, or is this a desperate measure after numerous stimulatory policies from the People's Bank of China and other authorities? Is this a last straw? Have they failed? Are they going to succeed? What do you think?
Very difficult to read, Lindsay, whether it's one or the other, probably a little bit of both. And also a third dynamic mixed in here is that they are trying to manage their economy. They are trying to bring about more of a soft landing so that they can avert a hard landing lower down the road. We've seen equity prices in China come off very, very hard, and they had to bring about some legislation there to stop short selling or to stop selling outright. I think this is just another sort of quiver in the bow, so to speak, just trying to manage the economy. And we're not really that surprised at the devaluation. Certainly, the way it's been done is a little bit surprising. 2 in a row, in 2 days. But I don't think it's one or the other. It's probably a whole a policy mix of all these things.
David, very quickly, what does it mean for South Africa? Number one, from my point of view, it means that the Chinese economy is confirmed to be slowing down a little bit worse than we expected. That's my layman's view, and therefore commodity demand from the world's second largest economy will be muted, and therefore that impacts us. The second thing that impacts us is the fact that if they devalue the yuan, which they have done, then their purchasing power is reduced, so they can't buy as many products from overseas, notably South Africa. Is that too simplistic, or is that relevant?
No, I think it is relevant. Look, we must remember that these currency wars started a good 7 years ago now, when the US printed money, the UK printed money, then Japan printed money, then Europe printed money, and China's. Well, they're not printing money, but certainly they are offering the market a lot of liquidity and devaluing the currency. So it's an ongoing battle to try to stimulate exports. But for me, it is a little bit of a futile game, because it's just a roundabout. It just goes on and on and on, and emerging markets get caught up in the excuse me, I forget the word I'm looking for, in the shrapnel of this battle. We do try to remain competitive, but as we know, and as you were saying to your previous guest, South African manufacturing is weak as it stands, and so we just do get caught up in all the shrapnel. But I think the biggest story, of course, is what the slowing Chinese economy does to commodity prices, and the impact that has on the South African economy down the line, as it feeds through into unemployment, as it feeds through into company closures, tax revenues, export revenues. That's the big story, is how this commodity cycle plays itself out.
Very quickly, 10 seconds. Next level on the rand, 13 or 1270?
Hugely difficult to call now. I think with the nervousness in the market, 13 is probably more likely at this stage, but the markets are extremely volatile. Friday we saw the rand trade up at 1280 and down to 1260 in 45 minutes. So very, very illiquid markets, very thin markets, very jittery markets, but I think 13 is probably more likely than 1270.
Dave, thanks very much for taking time to speak to us on the phone. Get onto your trading phone right now, because I can hear it ringing in the background. That's Dave Gracey, Head of Forex at Investec.